Finance is a branch of economics that studies the management of monetary and financial resources of individuals, companies and governments. Finance is concerned with analyzing investment, financing and savings decisions, as well as the risks and rewards associated with them. Finance can be divided into three main areas. Personal finance refers to the management of money by individuals and families, taking into account their income, expenses, savings, investments, debts, taxes, and short and long-term financial plans. Corporate finance refers to the management of money by companies, taking into account their objectives, strategies, capital structure, budgets, financial statements, investment projects, sources of financing and distribution of dividends. Public finance refers to the management of money by governments, taking into account their revenues, mainly taxes, expenditures, mainly public services, deficits or surpluses, public debt, fiscal and monetary policy. Definition of finance. There are many definitions of finance, depending on the focus and context. However, a general and simple definition could be the following. Finance is the science and art of managing money. This definition implies that finance has a scientific component, based on the use of mathematical, statistical and economic tools to analyze and evaluate financial decisions, and an artistic component, based on intuition, experience and judgment to make the most appropriate financial decisions according to the circumstances. Importance of finance. Finance is important because it allows us to understand how money works in the world, how it is created, how it is distributed and how it is used. Finance helps us make better decisions about our own money, both personally and professionally. Finance also helps us understand how businesses and governments work, as well as their impacts on society and the environment. Some benefits of finance are: they allow us to plan our financial future, setting goals and strategies to achieve them. They allow us to optimize our budget, controlling our income and expenses, and looking for ways to save and invest. They allow us to access external sources of financing, such as credit or loans, to cover our needs or take advantage of opportunities. They allow us to evaluate the profitability and risk of our investments, comparing different alternatives and diversifying our portfolio. They allow us to manage our taxes, looking for the most efficient and legal way to pay or reduce them. They allow us to contribute to economic and social development, supporting projects and initiatives that generate added value and welfare. Basic principles of finance. The basic principles of finance are the rules or norms that guide the financial behavior of individuals, companies and governments. These principles are based on fundamental economic concepts and financial logic. Some of these principles are: scarcity principle. Money is a limited resource and therefore must be used judiciously and efficiently. Principle of opportunity cost. Money has an alternative or sacrificed value when used in one option or another. For example, if we use money to buy a new car, we give up the value we could obtain if we used it to invest in a business. Compound interest principle. Money generates more money when it is invested at a positive interest rate and the interest is reinvested. For example, if we invest $1,000 at a 10% annual interest rate and reinvest the interest, after 10 years we will have $2,593.74. Present value principle. Money has a different value depending on when it is received or paid. For example, $1,000 today is worth more than $1,000 a year from now, because we can invest it today and earn a return. Principle of future value. Money has a different value depending on when it is received or paid. For example, $1,000 a year from now is worth less than $1,000 today, because we can invest it today and earn a return. Principle of risk and return. Money has a level of uncertainty or variability associated with its return or profit. Generally, the higher the risk, the higher the expected return, and vice versa. For example, investing in a new company has more risk but also more potential return than investing in an established company. Time value of money. The time value of money is a financial concept that indicates that money has a different value depending on when it is received or paid. This is because money can generate more money when it is invested or lent at a positive interest rate. Therefore, the value of money depends not only on the quantity, but also on the time and interest rate. To compare or equate amounts of money at different times, two financial tools are used: present value and future value. Present value is the present value of an amount of money to be received or paid in the future, discounting the interest rate. For example, if the interest rate is 10% per annum, the present value of $1,000 to be received 1 year from now is $909.09. Future value is the future value of an amount of money received or paid today, accruing the interest rate. For example, if the interest rate is 10% per year, the future value of $1,000 received today is $1,100 1 year from now. Risk and return. Risk and return are two financial concepts that measure the uncertainty and gain associated with an investment. Risk is the probability or variability of obtaining a lower return than expected or even losing part or all of the invested capital. Profitability is the return or gain obtained by investing capital over a period of time. Risk and return are related by the principle of risk and return, which states that the higher the risk, the higher the expected return, and vice versa. This means that investors demand compensation for assuming a higher level of risk, and are willing to accept a lower return for reducing their level of risk. Risk and return can be measured using different financial indicators, such as standard deviation, coefficient of variation, expected value, value at risk, Sharpe ratio, among others. These indicators allow comparing different investments and choosing the most convenient ones according to the investor's profile and preferences. Financial analysis. Financial analysis is the process of examining the economic and financial situation of a company or project, using accounting, statistical and mathematical information. The objective of financial analysis is to evaluate the performance, profitability, solvency, liquidity and risk of the entity or project, and thus facilitate decision-making by management, investors, creditors and other stakeholders. Financial analysis can be performed using different methods, such as horizontal analysis, which consists of comparing financial statements from different periods, to observe the evolution and growth of the company or project. Vertical analysis, which consists of expressing each item of the financial statements as a percentage of the total. To observe the structure and composition of assets, liabilities, income and expenses. Ratio analysis or financial indicators, which consists of calculating relationships between different items in the financial statements to measure aspects such as profitability, solvency, liquidity and risk. The analysis of projected financial statements, which consists of estimating the future financial statements of the company or project, based on reasonable assumptions and projections, to assess the viability and potential of the entity or project. Financial statement analysis. Financial statement analysis is a fundamental part of financial analysis, since financial statements are the main source of accounting and financial information for a company or project. Financial statements are documents that reflect the economic and financial situation of an entity or a project at a given time or in a given period. The main financial statements are the balance sheet or statement of financial position, which shows the assets, resources, liabilities, obligations, and equity, capital, of the company or project at the end of a period. The income statement or profit and loss statement, which shows the company's or project's revenues, inputs, and expenses, outputs, during a period, and the net result, profit or loss, obtained. The statement of cash flows or statement of changes in cash, which shows the company's or project's cash inflows and outflows during a period. Classified into operating activities, related to the normal course of business. Investing activities, related to the acquisition or sale of fixed assets, and financing activities, related to the raising or payment of external funds. The statement of changes in equity or statement of changes in stockholders' equity, which shows the movements in the company's or project's equity during a period, including net income, dividends paid or received, capital contributions or withdrawals, and other items. Financial statement analysis consists of applying the aforementioned methods, horizontal and vertical analysis, financial ratios and indicators, and projected financial statements, to the company's or project's financial statements to obtain relevant information on its economic and financial situation. Financial ratios. Financial ratios are indicators or ratios that show the financial situation of a company or entity, using accounting, statistical and mathematical information. The purpose of financial ratios is to evaluate the company's performance, profitability, solvency, liquidity and risk, as well as to identify its strengths and weaknesses, and to propose actions for improvement or correction. Financial ratios are based on the study of financial statements, which are documents that reflect the company's financial position, revenues and expenses, and cash flows. The most important financial statements are the balance sheet, the income statement and the cash flow statement. There are different types of financial ratios, depending on the aspect to be analyzed. Some of the most common are: debt ratio, measures the degree of leverage or dependence on external financing. It is calculated by dividing total liabilities by equity. A high value indicates a high financial risk and less autonomy. Solvency ratio, measures the company's capacity to meet its short-term obligations. It is calculated by dividing current assets by current liabilities. A value greater than 1 indicates that the company has sufficient liquid resources to pay its debts. Liquidity ratio measures the immediate availability of cash or cash equivalents to pay short-term obligations. It is calculated by dividing cash in banks by current liabilities. A value greater than 1 indicates that the company has a good cash position. Profitability ratio measures the yield or profit obtained by the company from its activity. It can be calculated in different ways, such as dividing net profit by sales, return on sales, by total assets, return on assets, or by equity, return on equity. Financial planning. Financial planning is the process of preparing a business or personal budget. Taking into account existing resources and focused on ensuring economic viability and achieving the long-term financial profitability objectives established in advance. Financial planning makes it possible to analyze the current financial situation and project future financial statements. Determining investment and financing needs, expected costs and revenues, and strategies to optimize them. Financial planning also facilitates the control and monitoring of the budget, making it possible to evaluate the results obtained and make the necessary adjustments to meet the established goals. Financial planning is important for both companies and individuals, as it helps to make informed and rational decisions on the use of money. To take advantage of opportunities and to prevent or solve financial problems. Personal budget. A personal budget is a document that consists of an estimate of the movement of money you have or expect to have in a given period, for example, a month. Indicating how much you are going to spend on your expenses and income. A personal budget allows you to plan how you will use your money, manage your income responsibly. Pay your debts on time, identify and eliminate unnecessary expenses, monitor your finances and define a savings plan. A personal budget is prepared by following these steps. Establish budget goals, such as saving for a trip, buying a home or reducing debt. Record the total income expected to be received during the period, such as salary, rent, interest or earnings from additional work. Record fixed expenses that must be paid during the period, such as rent, mortgage, utilities, taxes or debt repayments. Record variable expenses that depend on consumption or personal choice, such as food, transportation, clothing, entertainment or donations. Calculate the budget balance by subtracting total expenses from total income. If the balance is positive, it means that there is a surplus that can be saved or invested. If the balance is negative, there is a deficit to be covered with savings or credits. Review and adjust the budget periodically, comparing estimated values with actual values and making the necessary changes to improve money management. Retirement planning. Retirement planning is how you determine your retirement income goals and create a financial plan to achieve those goals. Retirement planning allows you to ensure your financial well-being and quality of life when you stop working. Retirement planning involves following these steps. Establish retirement goals, such as at what age you want to retire, what lifestyle you want to have, what activities you want to pursue, or what legacy you want to leave. Estimate retirement expenses, taking into account factors such as inflation, life expectancy, health, taxes and contingencies. Calculate retirement income, considering possible sources such as public pension, private pension, personal savings, investments or partial job income. Develop a retirement plan, defining a strategy for saving and investing enough money to meet your needs and wants in retirement. Regularly review and adjust the retirement plan, assessing progress and making changes as needed to adapt to changing market and life circumstances. Consider working with a financial advisor, who can guide you and help you make the best decisions for your future. Investments. An investment is an action that consists of allocating resources in order to obtain a future benefit. The resources can be money, time, effort, knowledge, etc. The future benefit can be an income, a profit, a saving, an improvement, a learning, etc. Investments are made with the objective of increasing the value or profitability of available resources, whether in the short, medium or long term. Investments imply assuming a risk, that is, the possibility of losing part or all of the invested capital. Therefore, investments require prior analysis and adequate planning. Types of investments. There are different types of investments depending on the type of resource invested, the term of the investment, the level of risk and the expected return. Some examples of types of investments are financial investments. These are those that consist of placing money in some financial instrument, such as stocks, bonds, mutual funds, currencies, cryptocurrencies, etc. These investments seek to obtain an economic return through interest, dividends, capital appreciation or exchange differences. Productive investments. These are investments that consist of acquiring or creating goods or services that generate income from their sale or rental. These investments seek to obtain an economic benefit through the production, marketing or exploitation of the assets. Examples of productive investments are machinery, vehicles, real estate, patents, franchises, etc. Personal investments. These are investments that consist of dedicating time, effort or knowledge to some activity that improves the quality of life or personal development. These investments seek to obtain a benefit that is not economic, but emotional, social or intellectual. Examples of personal investments are education, health, leisure, social relations, etc. Investment strategies. An investment strategy is a plan or a guide that orients the investment decisions of a person or an entity. An investment strategy should be based on the investor's objectives, profile and preferences. An investment strategy should consider aspects such as the time horizon. This is the time frame in which the return on the investment is expected to be obtained. Depending on the time horizon, a distinction can be made between short-term, less than 1 year, medium-term, between 1 and 5 years, or long-term, more than 5 years, investments. The level of risk. This is the probability of losing part or all of the invested capital. Depending on the level of risk, a distinction can be made between conservative, low risk and low return, moderate, medium risk and return, or aggressive, high risk and high return, investments. Diversification. is the allocation of capital among different types of investments in order to reduce risk and increase the chances of success. Diversification involves combining investments with different characteristics, such as degree of liquidity, volatility, correlation, etc. Profitability, it is the profit obtained for the investment made. Profitability can be measured in absolute terms, the difference between the final value and the initial value, or relative terms. The percentage that this difference represents with respect to the initial value. Profitability can also be expressed in nominal terms, without considering inflation, or real terms, considering inflation. Corporate finance. Corporate finance is a branch of finance that deals with the study and management of the financial resources of companies or organizations. Corporate finance aims to maximize the value of the company for its shareholders or owners. Corporate finance encompasses several areas, such as project evaluation. This is the process of analyzing the feasibility and profitability of an investment that the company wishes to make, such as the acquisition of an asset, expansion of a business, product innovation, etc. Project evaluation involves estimating the cash flows that the investment will generate, calculating the cost of capital that represents the financing of the investment and applying decision criteria, such as the net present value, the internal rate of return, the payback period, etc. Capital structure. This is the way in which the company is financed, i.e., the proportion between equity capital, resources provided by shareholders, and borrowed capital, resources obtained through loans or debt issuance. The capital structure influences the company's cost and financial risk, as well as its valuation and growth capacity. Dividend policy. This is the company's decision on how to use its profits. The dividend policy consists of determining how much of the profits are distributed to shareholders, dividends, and how much is reinvested in the company, retention. Dividend policy affects the value and liquidity of the shares, as well as investor expectations and preferences. Capital structure. Capital structure is the way in which a company is financed, i.e., the proportion between equity capital, resources provided by shareholders, and borrowed capital, resources obtained through loans or debt issues. The capital structure influences the cost and financial risk of the company, as well as its valuation and growth capacity. The optimal capital structure is one that minimizes the weighted average cost of capital, WACC, which is the rate of return demanded by the company's providers of funds. The WACC depends on the cost of equity, K, which is the return that shareholders expect on their investment, the cost of debt capital, KD, which is the interest the company pays on its loans or issues, and the level of indebtedness, DE, which is the ratio of debt capital to equity capital. The optimal capital structure also depends on business risk, which is the variability of operating profits. Financial risk, which is the variability of net profits, and the tax effect, which is the tax savings generated by interest payments. Dividend policy. Dividend policy is a company's decision on how to use its profits. Dividend policy consists of determining how much of the profits are distributed to shareholders, dividends, and how much is reinvested in the company, retention. Dividend policy affects the value and liquidity of the shares, as well as investors' expectations and preferences. The optimal dividend policy is one that maximizes the market value of the shares, which depends on the expected flow of dividends and the cost of equity capital. The expected flow of dividends depends on the level and expected growth of future earnings. The cost of equity capital depends on the risk perceived by investors and the general level of the market. The optimal dividend policy also depends on the life cycle and investment opportunities of the company, as well as the legal and tax environment. Some companies prefer to maintain a stable or increasing dividend policy to convey confidence and security to their shareholders. Other companies prefer to adjust their dividends according to their results or financial needs. Financial markets. A financial market is a place where financial assets, such as money, stocks, bonds, derivatives, etc., are exchanged. Financial markets facilitate savings, investment, consumption and production of goods and services. Financial markets are classified according to the type of asset traded, maturity, degree of liquidity and regulation. Some examples of financial markets are the money market, where short-term assets are traded, such as bank deposits, treasury bills, certificates of deposit, etc. The capital market, where long-term assets such as stocks, bonds, mutual funds, etc. are traded. The foreign exchange market, where currencies of different countries are traded. The derivatives market, where contracts that derive their value from other assets, such as futures, options, swaps, etc., are traded. Stock market. A stock market is a type of financial market where company shares are traded. Shares are parts of a company's capital stock that grant rights to their owners, such as receiving dividends, participating in decisions or selling them to other investors. The stock market allows companies to obtain financing by selling their shares and investors to obtain returns by buying them. The stock market is divided into two segments. The primary market, where companies issue new shares to the public for the first time or carry out capital increases. The secondary market, where investors buy and sell existing shares among themselves. The stock market is governed by a series of rules and bodies that guarantee its transparency, security and efficiency. Some examples are the stock exchange, which is the physical or virtual place where operations are carried out. Financial intermediaries, which are the entities that facilitate access to the market for investors and companies. Stock market indexes, which are indicators that reflect the behavior of the market or of a specific sector. Market regulators, which are the authorities that oversee compliance with the law and protect the rights of participants. Derivatives market. A derivatives market is a type of financial market where derivative contracts are traded. Derivative contracts are agreements between two parties that establish the conditions for exchanging an underlying asset on a future date at a given price. The underlying asset can be anything that has a variable value over time, such as a stock, a currency, a commodity, etc. The derivatives market has two main purposes. Risk hedging, which consists of using derivative contracts to protect against fluctuations in the price of the underlying asset. Speculation, which consists of using derivative contracts to make profits by betting on the movement of the price of the underlying asset. The derivatives market is classified according to the place where the transactions are carried out. The organized or exchange market, which is where derivative contracts are traded on a specialized exchange. That sets the standardized characteristics of the contracts and acts as a counterparty guaranteeing compliance. The non-organized or over-the-counter market, where derivative contracts are traded directly between the parties, who set the terms and conditions according to their needs and assume the risk of non-compliance. Financial products. A financial product is an instrument that allows economic agents to carry out financial transactions, such as saving, investing, financing or transferring resources. Financial products can be classified according to their nature, term, profitability or risk. Some examples of financial products are bank deposits, which are savings products that consist of delivering an amount of money to a financial institution in exchange for receiving interest and being able to dispose of the money at any time or at the expiration of the agreed term. Shares, which are investment products that consist of acquiring a part of the capital stock of a company and obtaining rights as owner, such as receiving dividends or participating in decisions. Bonds, which are financing products that consist of issuing a debt security that obliges the issuer to pay the holder a fixed amount of money plus interest on specific dates. Bank transfers, which are payment products that consist of instructing a financial institution to send an amount of money from one account to a different account. Stocks and bonds. Stocks and bonds are two types of financial products that belong to the capital market. Stocks are parts of a company's capital stock that grant rights to their owners, such as receiving dividends, participating in decisions or selling them to other investors. Bonds are debt securities that oblige the issuer to pay the holder a fixed amount of money plus interest at specified dates. Stocks and bonds have some important differences. Stocks represent an ownership interest in the company, while bonds represent a loan to the company. Stocks have a variable return that depends on the company's profits and value, while bonds have a fixed return that depends on the agreed interest. Stocks have a higher risk than bonds, as they can lose all their value if the company goes bankrupt or does not distribute dividends, while bonds have a lower risk, as they have priority of collection over stocks in the event of liquidation. Stocks have no maturity, while bonds have a fixed term. Mutual funds. A mutual fund is a type of financial product that consists of a pool of assets made up of contributions from several investors that is collectively invested in a diversified portfolio of financial assets, such as stocks, bonds, derivatives, etc. The mutual fund is managed by a management company that charges a fee for its services and is responsible for selecting the assets, carrying out the operations and distributing the profits. Mutual funds have several advantages for investors. They allow access to a greater variety and quality of financial assets than investing individually. They allow investors to reduce risk by diversifying investments among different assets and sectors. Benefit from the knowledge and experience of professionals specialized in financial management. Save time and cost by delegating management to the management company. Taxes. A tax is a payment obligation that the state imposes on its citizens, without any direct consideration in goods or services. Taxes are intended to finance public sector activities that are for the common good, such as education, health, security, infrastructure, etc. Taxes can be classified according to different criteria, such as the type of resource taxed, the term of payment, the level of government that levies them, or the effect they have on income distribution. Some examples of classification are: according to the type of resource taxed. Income taxes are those levied on the income or profits of individuals or companies, such as personal income tax, IRPF, or corporate income tax, IS. Consumption taxes, these are taxes levied on the expenditure or use of goods or services, such as value-added tax, VAT, or excise duties, E. Wealth taxes, these are taxes levied on the possession or transfer of goods or rights, such as wealth tax, IP, or inheritance and gift tax, ISD. According to the payment term. Direct taxes, these are those that are paid directly by the taxpayer, the party obliged to pay, such as personal income tax, IRPF, or corporate income tax, IS. Indirect taxes are those that are paid indirectly through an intermediary, such as VAT or E. Depending on the level of government that levies them. State taxes, these are taxes collected by the central government and are allocated to the general state budget, such as personal income tax or VAT. Autonomous community taxes, these are taxes levied by the autonomous communities and are allocated to the autonomous community budget, such as IP, ISD or some sections of IRPF or VAT. Local taxes, those collected by the municipalities and destined to the local budget, such as the real estate tax, EB, or the tax on economic activities, IE. According to the effect they have on income distribution. Progressive taxes, these are those that increase their tax rate as the tax base, the amount on which the tax is applied, increases, such as the personal income tax, IRPF. These taxes contribute to reducing inequality. Proportional taxes, taxes that maintain a constant tax rate regardless of the tax base, such as the IS. These taxes do not alter the distribution of income. Regressive taxes, taxes that decrease their tax rate as the tax base increases, such as some A taxes. These taxes contribute to increasing inequality. Tax basics. To better understand how taxes work, it is necessary to know some basic concepts, such as passive subject, it is the natural or legal person who is obliged to pay the tax. Active subject, it is the public entity, the state, the autonomous community or the municipality, that has the right to demand and collect the tax. Taxable event, this is the factual assumption established by law that gives rise to the tax liability. For example, in personal income tax, the taxable event is the obtaining of income, in VAT. It is the delivery of goods or provision of services, in ISD. It is the free acquisition of goods or rights by inheritance or donation. Taxable base, This is the amount on which the tax rate is applied to calculate the tax liability. The taxable base is usually equal to the value of the taxable event, but may be subject to reductions or deductions as established by law. For example, in personal income tax, the taxable base is the sum of the income obtained by the taxpayer, less deductible expenses, in VAT. The taxable base is the sale price of the good or service, plus the taxes levied on it, in ISD. The taxable base is the net value of the goods or rights acquired, less the charges or debts that reduce them. Tax rate. This is the percentage applied to the tax base to obtain the tax liability. The tax rate can be fixed or variable according to the law. For example, in personal income tax, the tax rate is progressive and depends on the scale of taxation established for each income bracket. In VAT, the tax rate is fixed and depends on the type of good or service, general, reduced or super reduced. In ISD, the tax rate is progressive and depends on the relationship between the donor and the donee. Tax liability. This is the amount resulting from applying the tax rate to the tax base. The tax liability is the amount to be paid by the taxpayer to the taxpayer. For example, if a person obtains an income of €30,000 and is taxed at a rate of 20%, his tax liability will be €6,000, 30,000 by 0.2. Tax debt. This is the payment obligation of the taxpayer to the taxpayer. The tax debt is composed of the tax liability plus surcharges, interest and penalties that may arise from noncompliance or delay in payment. Tax planning. Tax planning is the set of legal actions taken by a taxpayer in order to optimize its tax burden, i.e., to pay as little as possible within the limits established by law. Tax planning involves knowing the tax rules and taking advantage of the tax benefits or advantages they offer. Tax planning can be done at a personal or corporate level. Some examples of tax planning are: choosing the most appropriate legal form to develop an economic activity, taking into account the differences between the taxes levied on individuals, IRPF, and legal entities, is. Take advantage of the deductions or allowances offered by law to reduce the tax base or the tax liability. For example, in personal income tax, contributions to pension plans, donations to nonprofit organizations, expenses for the main residence, etc. can be deducted. Defer or anticipate income or expenses to take advantage of changes in tax rates or tax scales. For example, if tax rates are expected to rise in the future, it is advisable to bring the income forward to the present. If they are expected to fall, it is advisable to delay them to the future. Carrying out financial transactions that allow you to defer or avoid paying taxes. For example, investing in financial assets that do not generate returns until maturity or liquidation, such as fixed-term deposits or shares without dividend rights. Tax planning must respect the principles of legality, truthfulness and good faith. Tax planning should not be confused with tax evasion, which is the deliberate and fraudulent noncompliance with tax obligations. Loans and credits. A loan is a financial transaction by which an entity, lender, delivers an amount of money, principal, to another entity, borrower, under agreed terms of term, interest and form of payment. The borrower undertakes to repay the principal plus the interest generated in the established installments. A credit is a financial operation by which an entity, creditor, makes available to another entity, debtor, a maximum amount of money, limit. Under agreed conditions of term, interest and form of payment. The debtor can dispose of the money according to its needs, without exceeding the limit, and only pays interest on the amount used. Loans and credits are forms of financing that enable individuals or companies to obtain resources to cover their liquidity or investment needs. However, they also involve a cost and a risk that must be evaluated before applying for them. Types of loans. There are different types of loans depending on the purpose, term, interest rate, collateral or form of repayment. Some examples of types of loans are: depending on the purpose. Personal loans, these are those that are granted to finance any type of expense or personal consumption, such as the purchase of a household appliance, a trip, a reform, etc. They usually have a low or medium amount, a short or medium term and a high interest rate. Mortgage loans, these are loans granted to finance the purchase or construction of a home or real estate. They usually have a high amount, a long term and a low interest rate. In addition, they require a mortgage guarantee, i.e., the property remains as collateral for the loan and can be seized in the event of non-payment. Consumer loans, these are loans granted to finance the purchase of durable goods, such as a car, a motorcycle, a computer, etc. They usually have an average amount, an average term and an average interest rate. In addition, they may require a pledged collateral, i.e., the good remains as collateral for the loan and can be recovered in case of non-payment. According to the term. Short-term loans, these are those that are repaid in a period of less than 1 year. They usually have a high interest rate and are used to cover specific liquidity needs. Medium-term loans, these are loans that are repaid over a period of between 1 and 5 years. They usually have a medium interest rate and are used to finance moderate investments. Long-term loans, these are loans that are repaid over a period of more than 5 years. They usually have a low interest rate and are used to finance important investments. Depending on the interest rate. Fixed-rate loans, these are those that maintain the same interest rate throughout the life of the loan. This means that the installments are constant and do not vary with market fluctuations. These loans offer security to the borrower, but may also involve a higher cost if rates fall. Variable rate loans, these are loans with an interest rate that is periodically revised according to a reference index, such as Euribor. This implies that installments can go up or down with market variations. These loans offer flexibility to the borrower, but may also involve greater risk if rates rise. Mixed rate loans, these are loans that combine an initial period at a fixed rate with a subsequent period at a variable rate. This implies that the installments are constant during the first period and then may vary with the market. These loans offer an intermediate solution between the above. According to the guarantee. Loans with a personal guarantee, These are those that only require the borrower's commitment to repayment and solvency. In the event of non-payment, the lender can claim collection through the courts, but cannot seize any specific property of the borrower. These loans usually have a low or medium amount and a high interest rate. Secured loans, these are loans that require the borrower to deliver an asset as collateral for the loan. In the event of default, the lender can foreclose on the collateral and keep the property or sell it to recover the money. These loans usually have a high amount and a low interest rate. Depending on the form of amortization. Loans with single amortization. These are those that are repaid in a single payment at the end of the term. The borrower only pays interest during the life of the loan and repays the principal at maturity. These loans are usually short-term and are used for commercial or financial transactions. Loans with periodic amortization. These are those that are repaid in regular payments over the life of the loan. The borrower pays a portion of the principal and a portion of the interest in each installment. These loans can be fixed installment. The amount of the installment is constant, or variable installment. The amount of the installment varies according to the interest rate. Credit management. Credit management is the set of actions taken by an entity, creditor, to grant, control and recover the loans it grants to its customers, debtors. The objective of credit management is to minimize the risk of non-payment and maximize the profitability of loans. Credit management encompasses several phases, such as credit evaluation. This is the process of analyzing the creditworthiness and payment capacity of the credit applicant, as well as the purpose and conditions of the credit. The credit evaluation involves gathering financial, commercial and personal information from the applicant, verifying his credit history, calculating his financial ratios, estimating his future cash flows, etc. The credit evaluation makes it possible to assign a risk level to the applicant and to determine whether or not to grant the credit, as well as the amount, term, interest rate and guarantees required. The formalization of the loan. This is the process of establishing the contract that regulates the obligations and rights of the parties involved in the loan. The formalization of the loan involves drawing up the contractual document, specifying the clauses and conditions of the loan, such as the amount, term, interest rate, commissions, guarantees, insurance, etc. The formalization of the credit also involves signing the contract by both parties and delivering or disposing of the money. Credit monitoring. This is the process of monitoring the debtor's compliance with his obligations and verifying the status of the credit. Credit monitoring involves monitoring periodic payments, reviewing outstanding balances, updating interest rates, applying surcharges or penalties for late payment or non-compliance, etc. Credit monitoring also involves assessing the evolution of credit risk and profitability and taking corrective action if necessary. Credit recovery. This is the process of collecting the amounts owed by the debtor in the event of non-payment or insolvency. Credit recovery involves initiating extrajudicial or judicial actions to demand payment, negotiating payment plans or reductions with the debtor, foreclosing on collateral or seizing the debtor's assets, etc. Credit recovery also involves recording bad debt losses and provisioning for risks. Insurance. Insurance is a contract between a person or a company, the insured, and an insurance company, the insurer, that establishes the conditions and the price, the premium, for which the insurer undertakes to indemnify the insured in the event of the occurrence of an event foreseen in the contract, the loss. The purpose of an insurance policy is to protect the insured from the negative economic consequences that he or she may suffer due to the occurrence of a loss, such as an accident, illness, theft, fire, etc. There are different types of insurance depending on the object to be insured, the risk to be covered and the coverages to be contracted. Some examples of insurance are: life insurance. It guarantees the payment of a sum of money to the beneficiaries designated by the insured in case of death or permanent disability. Health insurance covers medical and hospital expenses incurred by the insured or his dependents due to illness or injury. Automobile insurance covers material and personal damages that may be caused or suffered by the insured vehicle or its occupants in the event of a traffic accident. Home insurance covers material and personal damages that may be suffered by the insured home or its inhabitants due to fire, theft, flood, etc. Life and property insurance. Life and property insurance are two types of insurance whose purpose is to protect the insured's assets and guarantee his or her well-being and that of his or her loved ones. Life insurances are those that guarantee the payment of a sum of money to the beneficiaries designated by the insured in the event of his death or permanent disability. Life insurance can be temporary life insurance. These are those that have a fixed term, for example, 10 years, 20 years, etc. If the insured dies or becomes disabled within the contracted term, the insurance pays the indemnity to the beneficiaries. If the insured survives the contracted term, the insurance policy expires without paying anything. Whole life insurance. These are those with an indefinite term, i.e., until the death of the insured. The insurance pays the indemnity to the beneficiaries when the death of the insured occurs, regardless of the time of death. Life insurance with savings. These are those that combine protection for death or disability with the accumulation of a capital sum that can be redeemed by the insured at any time or at the end of the contract. Property insurance policies are those that cover the material damage that may be suffered by an asset owned by the insured due to a loss. Property insurance can be fire insurance. These cover damage caused by fire or explosion to the building and contents of the insured property. Insurance against theft. These cover the loss or damage to the insured property due to theft with force or violence. All risk insurance. These cover any type of material damage that the insured property may suffer, except for the exclusions expressly established in the contract. Risk management. Risk management is the process by which the risks faced by an organization or an individual are identified, analyzed, evaluated, controlled and monitored in order to minimize their negative effects and maximize their opportunities. Risks are uncertain events that can positively or negatively affect the established objectives. Risks can be classified according to their origin. Internal risks, those that come from within the organization or individual, such as human error, technical failures, fraud, etc. External risks, those arising from the environment, such as, for example, legal changes, competition, natural disasters, etc. Risk management involves the following steps. Risk identification consists of recognizing and describing the possible risks that may affect the organization or the individual, as well as their causes and consequences. Risk analysis consists of estimating the probability of occurrence and impact of each risk, as well as its relationship with other risks. Risk assessment consists of prioritizing risks according to their importance and urgency, taking into account the established criteria and tolerance levels. Risk control consists of defining and applying the appropriate measures to prevent, reduce, transfer or accept each risk, according to its level of exposure and its cost-benefit. Risk monitoring consists of verifying compliance and effectiveness of control measures, as well as detecting and responding to changes that may affect risks.